Welcome to today's session on foreign exchange. In this session, we'll cover the building blocks of FX markets, starting from currency codes and basic terminology, moving all the way to forwards, swaps, and even precious metals. Let's begin step by step. Base currency and quoted currency. ISO codes for G20 currencies. Big figure and points, pips. Bid, offer and price maker versus price taker. Choosing the best spot rate and more. Let's start with the most fundamental concept in FX trading, the currency pair. In any FX quote, the first currency is called the base currency, and the second currency is the quoted currency. For example, in the pair euro to US dollar is equal to 1.0725, 1.0727. The euro, EUR, is the base currency. The US dollar, USD, is the quoted currency. This quote tells us how many US dollars are required to buy 1 euro. Here, 1 euro costs about $1.0725 to $1.0727, depending on whether you are buying or selling. Another example is US dollar to Swiss franc is equal to 0.9845, 0.9847. The US dollar, USD, is the base. The Swiss franc, CHF, is the quoted currency. So, this quote tells us that 1 US dollar is worth about 0.9845 to 0.9847 Swiss francs. The rule is simple. The base currency is always 1 unit. The quoted currency tells us how much of that currency is needed to buy 1 unit of the base. Now that we've understood base and quoted currencies, let's move to the ISO codes used for currencies, especially for the G20 countries. Currencies in the global FX market are standardized using ISO 40 to 17 codes. These are always 3-letter codes. The first 2 letters usually represent the country. The third letter represents the currency name. For example, USD is equal to United States dollar. JPY is equal to Japanese yen. INR is equal to Indian rupee. On this slide, you can see the list of G20 members and their ISO currency codes. For instance, Eurozone countries use the euro, EUR. Japan uses the yen, JPY. China uses the renminbi, CNY. India uses the rupee, INR. This standardization is critical because it eliminates confusion in FX trading, where multiple countries may have similar currency names. For example, dollar is used in the US, Canada, and Australia, but the codes USD, CAD, and AUD make the distinction very clear. However, there are few exceptions to this general rule, such as CHF for Swiss franc, but it stands for Confederation Helvetica franc. Similarly, ZAR for South African rand is for Zuid-Afrikaan rand. In foreign exchange trading, currency pairs are quoted with precision, often up to 4 or 5 decimal places. 2 important concepts here are: 1. The big figure. 2. Points or pips. Let's break it down. In the quote, euro to US dollar is equal to 1.0725/1.0727. The big figure is 1.07. It remains constant for both bid and ask. The last 2 digits are called points or pips. Here, the spread is 2 pips, 25 versus 27. In the quote, US dollar to Swiss franc is equal to 0.9845/0.9847. The big figure is 0.98. The pips are the last 2 digits, 45 and 47. The spread again is 2 pips. A pip is the smallest price movement in the FX market. For most major currencies, it is the 4th decimal place, 0.0001. So if euro to US dollar moves from 1.0725 to 1.0726, that's a 1 pip move. Traders often focus on the last 2 digits because that's where short-term trading action happens. In summary, the big figure gives us the main level of the exchange rate. The pips or points represent the fine movements that traders watch closely. Now that we've discussed spot rates, forward rates and the cross rates, let's move to benchmark fixings, the reference rates for pricing. Then we look at FX outright forward rate, built from spot, forward points, and interest rate differentials. We'll then see forward cross rates and forward value dates for standard periods. After that, compare outright forwards with FX swaps. One is a single deal, the other a spot plus forward. We'll also cover hedging forwards with spot plus money markets, using FX swaps for synthetic positions, and then move to forward swaps. Finally, we'll close with historic rollovers and early or late settlements. By the end, you'll clearly see how forwards and swaps connect FX with interest rates and arbitrage. 1. Pricing and valuation. Benchmark FX fixings, like WM Reuters 4 p.m. London fix, RBI reference rate for USD INR, serve as standard reference points for pricing spot, forward, futures, and options contracts. Without benchmark rates, valuation would differ across banks, leading to inconsistencies. Example: a corporate hedging its euro to US dollar exposure will value its forward contracts using the WM Reuters euro to US dollar fixing. 2. Settlement of FX contracts. A large share of FX derivatives, swaps, forwards, options, are cash-settled against published benchmark rates. This avoids manipulation by counterparties and ensures fair settlement. Example: in India, many currency futures traded on NSE or BSE are settled based on the RBI reference rate. 3. Global trade and investment. Exporters, importers, and investors rely on benchmark rates to price and settle cross-border deals. Provides uniformity across geographies so that a Japanese exporter to Europe or an Indian importer from the US uses the same global reference. Example: a multinational preparing consolidated accounts in USD uses benchmark FX rates for translating foreign earnings. 4. Arbitration and dispute resolution. FX contracts often involve legal disputes. Example: pricing errors, mismatched settlements. Benchmark fixings are accepted by courts, arbitrators, and regulators as independent, neutral references. Example: if two banks disagree on the US dollar to Japanese yen rate for a forward contract, they can refer to WM Reuters 4 p.m. fix as the binding settlement rate. 5. Market transparency. Benchmark rates are published by independent agencies. Example: WM Reuters, RBI, ECB. Ensuring visibility and credibility. Prevents market manipulation and builds confidence among participants. 6. Risk management. Corporates, fund managers, and banks use benchmark rates for hedging exposures. Provides consistency for calculating mark-to-market, MTM, value at risk, VAR, and portfolio stress testing. Example: an Indian IT company hedging USD receivables will measure hedge effectiveness using the RBI USD INR reference rate. 7. Central bank operations. Central banks monitor benchmark FX rates to gauge currency stability and intervene when needed. Used in monetary policy formulation, foreign reserve management, and reporting. Example: RBI publishes the daily reference rate for USD INR, EUR INR, GBP INR, and JPY INR. ECB publishes the Euro reference rates for major currencies. Now let us move to the concept of FX outright forward rates. When we deal in the foreign exchange market, we don't just look at the spot rate. Very often, importers, exporters, banks and investors need to fix the exchange rate for a future date. This is done through a forward contract. The forward rate is calculated by taking the spot rate and then adding or subtracting the forward points. These forward points are derived from the interest rate differential between the two currencies. White point in backhand index. Let us look at the euro to US dollar example on the slide. Spot rate is quoted as 1.0732/1.0734. 1-month forward points are 8/10. 2-month forward points are 16/18. 3-month forward points are 24/26. Now let's interpret this. 1. Suppose a customer wants to buy euro to US dollar for 1 month. The buying rate for the customer is the right-hand side of the spot, that is 1.0734, and then we add the right-hand side of the forward points, which is 10 points. So the 1-month forward buying rate is equal to 1.0734 plus 0.0010 is equal to 1.0744. 2. Suppose the bank is buying euro to US dollar for 2 months. The bank will use the left-hand side of the spot, which is 1.0732, and then add the left-hand side forward points, which is 16 points. So the 2-month forward buying rate for the bank is equal to 1.0732 plus 0.0016 is equal to 1.0748. 3. Now, let's take an importer who wants to buy EUR for 3 months. Again, importer buying means we look at the right-hand side of the quote, which is 1.0734, and add the right-hand side of the forward points, which is 26 points. So the 3-month forward rate is equal to 1.0734 plus 0.0026 is equal to 1.0760. Now, the important principle. If the base currency interest rate is lower compared to the other currency, then the forward rate will be higher than the spot rate. The difference is called a premium, and this premium is always added to the spot rate. Finally, let's remember how the premium applies. For price takers, left side premium applies for selling, right side for buying. For price makers, right side premium applies for selling, left side for buying. So in short, forward points tell us how to adjust the spot rate based on the interest rate differential. If the euro interest rate is lower than the dollar interest rate, then the forward rate will be at a premium. This ensures fairness and removes any arbitrage opportunities between spot and forward markets. Welcome back to the session 3 of the foreign exchange module. In this session, we will discuss the forward premium and discounts and the precious metals. Let's now understand how cash, term, and spot forward premiums work. When we talk about premium scenario, remember 2 key rules. 1. Cash and term levels. These are derived by deducting the premium on the opposite side of the spot. That means, if spot euro to US dollar is 1.0732, 1.0734 and term spot premium is 1/2, we adjust on the opposite side to arrive at term levels, which makes it 1.0730, 1.0733. 2. Forward levels. These are derived by adding the premium on the same side of the spot. So, for example, if the 1-month forward premium is 8/12, we add this to spot 1.0732, 1.0734, giving us 1.0740, 1.0746. In short, for calculating cash and term rates from spot rates, deduct premium from opposite sides of spot rates. For forward, add premium to spot rates in the same side. This adjustment ensures correct bid-offer spreads across maturities. Now let us move to the concept of FX swaps in the money market. When we talk about FX swaps, you'll often hear terms like cash term, term spot, cash spot, and spot forward. These are simply combinations of 2 legs, a near leg and a far leg, which are nothing but 2 opposite transactions in foreign exchange. For example, cash term. See, T1 leg settles today, the other settles tomorrow. Term spot. TS1 leg settles tomorrow, the other on the spot date, which is 2 business days from trade date. Cash spot. CS1 leg settles today, the other on the spot date. Spot forward. SF1 leg settles on the standard spot date, and the other at some forward date. So, in short, all of these are FX swaps, just with different settlement combinations. Now, why do we actually do these swaps? There are several practical situations. 1. Customer forward cover. Sometimes a customer books an outright forward contract. To manage this, the bank uses a swap to adjust the maturity. 2. Trading rollover. A dealer may have taken a spot position but doesn't want to close it. Instead, they roll it forward to a future date using a swap. 3. Funding mismatch. A company may be surplus in one currency and short in another. A swap allows them to convert without taking open FX risk. 4. Borrowing constraints. A business may only be able to borrow in one currency but needs another. Again, a swap provides a cost-effective solution. 5. Covered interest arbitrage. If there's a difference in interest rates between two currencies, traders can use swaps to lock in a risk-free profit. 6. Hedging currency futures. If someone has a position in currency futures on an exchange, they may use spot plus swaps in the OTC market to manage exposure. 7. Maturity mismatches. If inflows and outflows in currencies don't match perfectly, swaps help bridge the gaps. 8. Swap trading and arbitrage. Finally, professional traders actively use swaps themselves to exploit arbitrage opportunities or to manage liquidity.